Let's connect with Andrew Holland. He is Chief Executive Officer with Ambit Investment Advisors. Andrew, good morning and thank you for joining us. Andrew, markets are moving from strength to strength. Some are of the view that this is markets' way of really judging the rate of change, and others would insist that this is a pure short covering stroke technical rally.
No, I'm not sure it's a short covering technical rally. I think you've had two bits of good news. One, the global markets have been very supportive of the Indian market as well, and of course with the state election results, it was the kind of icing on top of the cake for the market to move higher. We're not chasing the market at these levels. We think it's trying to look too far forward. I think with tapering coming probably now looking like January, I still think there's more volatility to come in the first quarter of 2014. So great run and justified in terms of the sentiment, but I think it's been helped by global factors as well. And I think if you take those global factors, I think we'll start to see more volatility in 2014 first quarter, and I think that will take some of the spice away from our markets.
So Andrew, from now to the general elections, do you think the ceiling of the market could go much higher, or do you think we will stick around with 6,400, 6,500 being the top at max?
We might do in the first quarter, but obviously, as we get nearer to the elections, I'm sure, again, we'll get kind of Modi fever and extrapolate the state election results and say, we're hoping that they'll get in with a clear majority. I think people feel that Modi is going to come in with big bang reforms, and that's going to kickstart the economy. Our view hasn't really changed from a few months back, is that we do expect a bull market to start in 2014 after the elections, and whichever government comes in, we do believe that the GDP growth will start to accelerate to 5.5% from around 4.5% this year, and then on to 7%. But the real kicker will be to earnings, where the operational and financial gearing of Indian companies is really significant, and I think that's what's going to be the driver of the markets going forward. So I think, if I could kind of summarize the first half up until the elections, maybe a volatile first quarter given global factors, and then possibly a rally if people get excited about the prospects of the BJP getting in. But thereafter, we're still saying that we'll have a bull market, or start the bull market from after the election onwards, as the GDP starts to accelerate and earnings accelerate even more.
Andrew, the problem with the current market setup is that the run-up has been extraordinarily strong. No one has participated. Everyone is feeling left out. So for those who have not participated, and let me assure you, there are a lot of people who have not participated, how should they approach the market now? Should they jump in now, wait for a correction?
Yeah, I mean, again, a few months ago, we started to do our switching from defences, particularly pharma and consumer. We still like IT into utilities, autos, metals, and industrials, and that started to pay off. But would I chase these stocks at this moment? No, not really. So I think there's going to be some comeback or pullback in the markets in the first quarter, and that's where I'd be kind of deploying again into these sectors. I don't need to kind of chase at the moment. I think the market's euphoric for the right reasons, but I think the ground reality is that it's not as good as we'd like it to be. So there's still time. I think I don't want to chase. I certainly don't want to chase the banks. I have heard many compelling reasons why. But I'd rather still rent this sector than own it. I really don't want to own the banking sector.
Well, Andrew, if you're so cautious about banks, I'm sure you're definitely not going to, even venture into names like power, or for that matter, cement and cap goods, which are off late seeing trading bounces.
No, I said, 2 months ago we started to move our sector allocations from defensives to industrial, so that includes obviously the cap good companies, and also we started to look at the utilities, so that's the power. So, we have been nibbling away at some of these companies. And also in the auto sector, a company which I've mentioned before, like a Barrett Forge, where they've got huge operational gearing, which is being helped obviously by the recovery in the US and Europe. And if the economy picks up as we expect from the second half of next year, then you're going to get operational gearing continuing to increase for them. And that's a huge impact on the bottom line and a positive impact. Throw in financial gearing as well as interest rates come down. And this is the kind of story you want to look at. And start, buying, ahead of that kind of move. We think there's a 50% increase in the share price over the next 1 year for a company like Barrett Forge. So you can look at these companies within these sectors and pick out which ones you feel are well placed from an earnings viewpoint as both the developed markets start to recover in terms of their economies and the Indian economy starts to recover too.
Andrew, I'm not sure if you've looked at the new CERC guidelines, but the message here is very clear. The message here is to regulate and control the returns some of these utility companies are enjoying. So if the intention is to regulate and control or cap the returns, do you think that is bad news for power sector in general? Because the power sector has suffered a lot because of government policies. At a time when the sector should be opened up, the CERC is looking at constraining it further.
Yeah, they are draft guidelines. I mean, if India is going to, improve its growth, then obviously power is going to be part of that equation, and there's huge, investments that's needed. So I'd be surprised if the full form of this is actually reality. I don't think you can start limiting ROEs, in a sector which is, starving of funds at the moment. So unless you make it attractive enough, no one's going to come. That's for sure, and no one's going to invest. That's for sure. So I see these as draft guidelines. I wouldn't read too much into it right this minute.
Andrew, so what's the call on spaces which have done well so far? The likes of pharma, FMCG, or for that matter, IT. Looking at the kind of uncertainty and the likes of big political events which are going to take place from now up until next year, would it be a prudent call to stick it with defensives, IT as well as pharma?
Pharma, no. We feel there's obviously certain companies which will do well, like a Biocon, but there's a lot of regulation that's happening out of the US, and it's been affecting more and more companies in India, and this is starting to spook investors, particularly when you're paying 20-30 times 1 year forward. In terms of the consumer sector, again, I understand the story and love the story for domestic consumption, but I don't really want to pay 40 times 1 year forward for that. So we have made a definite switch out of this sector into the sectors I mentioned. Against that, you do have some interesting stories. United Spirits is an interesting story going forward, and my old favourite Tata Global Beverages, because of Starbucks, I think will be an ongoing story. So you can pick out selective companies within this sector, but as a sector overall, we'd be underweight these sectors now. IT, we still feel there's a lot more to go forward, and our favourite there, Tech Mahindra, will continue to do well, and that's a favourite of ours. We think there'll be consolidation in the share price, but going forward, we think it's moved into a new league, and that will be reflected going forward in terms of its ratings and FII ownership going forward.
Andrew, really good chatting with you. It always is. Thanks as always for taking time out and speaking with us.